Scotia beating earnings estimates in its latest quarter. However, our guest feels this is a somewhat lower quality beat because it wasn't driven by strength in the regular banking division. Let's get more from Rebecca Teltscher, Portfolio Manager at Newhaven Asset Management. Rebecca, great to see you, and thanks very much indeed for joining us. So that's what you essentially look for with reports like this, the regular banking to outperform?
I mean, obviously we look at it as a whole, but, I guess when I'm looking at the banks, I want to see overall health in the economy and sustainable growth. And that's more something you would look at for loan growth, provision for credit losses, I think, and that's more what investors are looking for. Obviously, today's earnings were pretty good. But if I'm looking at the two largest beats, like the segments that had the largest beats, it was wealth management and capital markets. So like wealth management was up 17% year over year, capital markets up 50% year over year. And what we've seen historically is those segments can be very inconsistent, and they're also very much based on what the market is doing. I've been saying for a while, it's like a self-fulfilling prophecy, right? So, the stock market's doing really well this year. And so obviously more investors are getting invested in the market. That's going to drive AUM up. That's going to drive, transactions up on the capital market side. So it's not surprising those two segments are the best performing segments in a market like this.
The Canadian bank stocks near record highs. They got there on Friday. They're not far off that now. Valuations in the sector giving you something of a pause?
Yeah, it's interesting. I always say you could be a really good company, but not necessarily a good stock at that time. And that's how I feel about the banks right now. So, am I worried about the banks, financial health? Absolutely not. Like, do I think the banks are going to, survive and prosper in the next 20 years? Sure. They're well capitalized. They're well managed. So I am positive about the banks as a company. Where I have a little bit of concern right now is more on the valuation side. So, the average bank, like the banks as a whole, are trading at about over 13 times earnings. Historically, banks traded around 11 times earnings, or a little bit over 11. But it's interesting how it's trading at such a premium in the face of a weakening Canadian economy. I mean, to me, I feel as if Canada is already in a recession or inching its way towards it. So, it's odd to see, banks performing so well when we're seeing signs of economic weakness. I mean, the banks on average are up 30% year to date. Scotia in particular is up 25% year to date, a little bit more, right now after today's earnings. So a little bit of cause for concern with regards to adding new money to the sector now. That being said, we are invested in the banks for our existing clients. We're just hesitant to add additional money at these valuations.
And Scotia trading slightly below in terms of price earnings. Sorry, just go over that again. And the highest yield of the group?
Yeah, so Scotia, I mean, is on a valuation basis is cheaper than average. So we talked about the average being over 13 times. Scotia's a little bit less than 12. So I feel a little bit more confident. However, Scotia is still trading above its long-term average with itself, about 10 and a half. So again, because Scotia's just had, issues with regards to its international business and some management changes. So I think it has a little bit more to go with regards to getting back on track for consistent growth. But, it is also trading at the highest dividend yield of the bunch at 4.5% yield. It's interesting, the banks have always been these consistent dividend, strong dividend yields. But now with, the stock prices inching up so high, Royal Bank is now having a less than 3% dividend yield. So for yield investors like us, it's surprising to see such low yields in the bank when we're used to seeing more like higher yields.
Laurentian Bank finally finding a buyer and a premium, but if we look at a 5-year stock, still investors aren't getting the share price that it traded at a few years ago.
I think this is I think, Laurentian Bank shareholders should be thanking their lucky stars that they were able to to get a deal. I think, 2 years ago, they announced that they were looking, for like they had a strategic plan. That didn't go through. They couldn't find a buyer. Stock dropped from, $43 to $25 in a matter of 2 months. But now, the deal at $40 is pretty close to what what it was originally trading at 2 years ago. And, since then, we've seen, Canadian banks don't really have so much of an appetite. I think the one bank that had the appetite, National Bank, then they went out and purchased CWB. And so, all hope for them purchasing, Laurentian at that time, went out the window. But now we're seeing this transaction kind of like a little bit of a hybrid where they're taking on some of the assets, but not much of the risk in terms of the branches or employees. And then they found a private buyer, which is a best case scenario, I think, right now for Laurentian Bank. I don't think anyone else is willing to buy it or pay, what they would pay, what they were looking for 2 years ago.
Rebecca, for the rest of the year, what do you think you'll be doing? I actually saw a funny thing on Instagram today, a lady saying that at this time of the year, she adopts a policy of let's deal with it in the new year. Let's circle back next year. But you're busy. I know it's a busy time for portfolio managers. What will you be doing for the rest of December?
Praying for no more dividend cuts. I mean, we've seen a few this year, some that we own, some that we don't own. It's and just, staying the course. I mean, markets continue to be, in our opinion, overvalued, reasonably valued in some sectors, but overvalued in a lot of other sectors. And that's causing concern for us. So we are not rushing to deploy new capital. Our clients that are invested remain invested so they can compound those dividends. But for new money coming in and for those dividend flows that are coming in, we are, holding that in cash on the side, waiting for a better opportunity.
Rebecca, thank you very much indeed. And I hope we get to talk to you again in 2025. You're always one of our favorites. Rebecca Teltscher.
Well, I'm on Market Call on Thursday, so you don't have to wait too long.
We can never get enough of you. Rebecca Teltscher.
Thank you so much.
Portfolio Manager at Newhaven Asset Management.